Today we are live on Zoom and also live on YouTube to discuss a very powerful strategy that has helped a lot of international, institutional, retail, a lot of traders to become very, very profitable in this industry. And we have taken a lot of time to look at this strategy. And looking at the entire strategy, we discover that this strategy is in a way complex for a lot of people to navigate. So we have been able to summarize this strategy and put it into a 12-page PDF, a summary of the entire complex strategy. And further, we are compressing it right now in a very short video clip of less than 1 hour. So I am going to be taking you through step by step on the fair value gap trading strategy on the assumption that, number one, you have gone through a basic training of what Forex trading is all about. So forgive me if you don't see me talking about the basic rudiment, like what is a candle, what is a pip, what is a lot size, what is a bullish candle, what is a bearish candle, what is a pin bar, what is a swing high, what is a swing low, what is all the elementaries of Forex trading basics will not be covered on this short training. So I will allow you to go back to your broker. In your broker back office, there is a place, there is an area in the back office that allows you to see basic training. What is Forex trading all about? What are the trading sessions? What are the asset classes? What is candle patterns? What are chart patterns? Support, resistance, basic. You will see that in the normal trainings that brokers provide in the back office. I think almost all the whole brokers, I know they provide it. I know Capital Extend provide this. I know several other brokers, a lot of them. I don't want to go mention the name of brokers. Equity provides it, Hantech provides it, Tentrade provides it, Alpari provides it, XM provides it. A lot of brokers that you all know out there, they have trainings in their back office. So go and watch these training videos. They are simple basics of Forex. Go and watch these training videos, training ebooks. They are simple basics of Forex. Then after watching them, forget about everything you have watched, because you will need to come into the reality of profitability where you need a solid strategy like the fair value gap trading strategy. So if you have even known a lot about the basics, please leave it outside as we go through the next 1 hour. Straight to the point, the fair value gap is a 3 candlestick pattern that occurs when there are inefficiency, or let me say imbalance in the market, or when the buying and the selling are not equal. Fair value gap can become a magnet for the price before continuing in the same direction. Now, all of this may be big for you to understand, but the summary of what we are saying on the very first page, and which is from the basis of our discussion, is the fair value gap. You hear me say FVG, fair value gap. For you to identify a fair value gap, there must be 3 candles. 3 candles form a fair value gap. 3 candles. The first candle, whatever the candle is, color doesn't matter. The second candle, the third candle, the colors do not matter. However, if they are of green, it is a bullish fair value gap. And if they are of red, it is a bearish fair value gap. So the main point, or the main factor that is determining whether we have a fair value gap, is the distance between the first candle, where the candle ended here, and the third candle where it started from. If there is a distance between them, that distance is called fair value gap. I want you to take note of this definition in pictorial form. We are going to be discussing about these gaps as we go on. In the market, there are so many candles, millions and billions of candles in smaller time frame, medium time frame, higher time frame, but you are only considering 3 candles. Any 3 candles put together, you will consider it and you will check if there is a fair value gap or there is no fair value gap. This is candle number 1. This is candle number 2. This is candle number 3. The first candle ended here. A bearish candle goes down, so we say starts and end. A bullish candle goes up, so we say starts and end, right? So the candle started here. We call it swing high. The candle ended here. Where this candle ended, the first candle, we mark that line. Then we leave the second candle alone. The third candle, where the third candle started from, we mark that line. So this gap is called fair value gap. As a matter of fact, this is a red one, so we call it a bearish fair value gap. In this case, we call it a bullish fair value gap. For you to understand what I've said, I need to compare it with what a fair value gap is not, so you can really appreciate what I've said. These are 2 pictures of 3 candles. A fair value gap is dealing with 3 candles. Out of so many candles, you just narrow your focus to 3 candles. That is when we are talking about fair value gap. So in this situation, the first one here, this scenario, we have 3 black candles. They are actually bearish. The bearish represent the red. The bearish also represent the black, depending on color, whatever the trader usually chooses. But I see mostly the bullish, they use green, and some traders use blue for the bullish candles. So, but that is by the way. When you have 3 candles in your focus, the first candle, the second candle, the third candle, where this third candle end, because it's a downward movement, so we say it started from the top, it ended here. That line is marked. Where the third candle, forget about the second candle, which is in the middle, no. Where the third candle starts from, we mark that line. The gap between these 2 places, that gap is called the fair value gap. It's a very important gap. As a matter of fact, this gap, if you look at what I wrote here, the fair value gap trading is a significant price pattern in trading that highlights market imbalances resulting from rapid price movement. By understanding and identifying fair value gaps, traders can gain insights to potential trading opportunities. With a balanced approach, traders can leverage the fair value gap to enhance their decision-making process and strive for profitable outcome in the dynamic world of financial markets. This grammar is too plenty for somebody who is trying to learn fair value gap. So I can go back to the picture and explain myself again. This time around in a bullish situation, remember the bull candles, the green ones, the one going up. 3 candles are required. 1, candle 2, candle 3. The first candle is important where it ended. Of course, it started from the ground, it went to the top. The peak of the candle is what we are considering. If the candle doesn't have a wick, then we are considering where the candle ended in the body form, right? Forget about the second candle. We don't talk about it. We don't really consider it here in describing a first value gap. We describe the first candle and the last candle, the third one. So where the third candle starts from, the gap between the first candle ending, the third candle starting, that gap is called fair value gap. What if there are no gaps? Look at this case. Candle number 1 ended here. Candle number 2, we don't talk about it. Candle number 3 overlapped where candle number 1 ended. So there is no fair value gap here. What about the situation going up, the bullish scenario? 3 candles have been identified. Candle number 1 started here, ended here. Candle number 2, we don't consider it. Candle number 3 started where candle number 1 started from. In the same level. So That means there is no gap between the ending of candle 1 and the beginning of candle 2. There is no gap. Therefore, we say there is no fair value gap here. So you must know by the end of this slide right now, before I go to the next slide, where there is a fair value gap and where there is no fair value gap. If you don't understand what I've shown you on this page, put 1 on the chat box. If you don't understand what I've shown you on this page, put 1 on the chat box. If you understand what I've just shown you, the definition of fair value gap in words and also in the picture format, please put FVG on the chat box. If you all understand the definition, what I mean by fair value gap in description, please put FVG on the chat box. Those who understand, kindly explain to those who do not understand. Let them watch the video again. We'll repeat as we go on. I will repeat as we go on. I will repeat. Thank you. The next page. The next page, we are going to be talking about the main chart. Where is a fair value gap here in the main chart? And when we identify a fair value gap, what are we going to do with a fair value gap when we identify it? Or no, that's not the right word. What happens to a fair value gap when we identify it in the market? What happens next? That's what we are discussing here in the next 3 minutes. Barrister GB, pay close attention. This is your final opportunity to understand this. Pay close attention right now on this screen. Barrister Jimmy, look at this candlestick. Green, black, green, black, green, black, green, black, green, black, like piano. The green ones are the candles that are going upwards. The black ones are the candles that are going downwards. The color do not matter. I just want to find out 3 consecutive candles going in the same direction or going in opposite direction. It doesn't really matter. But if we can find 3 consecutive candles going in the same direction, it's very good for our explanation. Look at what I found. These 3 consecutive candles. So when you identify 3 candles, that means you are trying to pick out a fair value gap. These candles are on their way downward, black candles. The first candle ended here. I mark it by a line. The second candle continued. I don't bother myself about marking it. The third candle, this one, started from here. So I mark it by a line. So I can say that there is a gap between where the first candle ended and where the third candle started. There is a gap. If there is a gap, that gap is known as FVG, fair value gap. The gap between the first candle and the third candle. When that gap is formed, the market begins to react. Sometimes the market reacts immediately and go into the gap. Sometimes the market wastes a lot of time dancing around before it goes into the gap. Sometimes the market never, ever, ever go to the gap for a very long time. But sometimes later in the future, the market must go back into that gap. So let me read what the grammarians will talk about. Consequent encroachments. Consequent encroachment is the process of the candles after forming fair value gap coming back again to encroach into the fair value gap that has been formed before. The market comes this way from the left to the right. Form fair value gap here. We mark the fair value gap area here by that box you see there. After marking the fair value gap, we see the price going close. It didn't go in. It's move, and we see eventually the price enter into the fair value gap here. The fair value gap area, we mark the price enter into it. When the price enter into the fair value gap area we marked, we are expecting that fair value gap to repel the price, repel this candle, push it back to where it's coming from. Odeshi. It's coming from down and enter the fair value gap, it will be repelled. That's one of our major expectations of a fair value gap. Why are we expecting that? Because we have studied this fair value gap long enough to notice that it works like a magnet. You know, a magnet has two functionalities or characteristics, which is the ability to repel and also the ability to attract. That is exactly what the fair value gap zone, that zone you mark, fair value gap zone, it works like a magnet. It draws the price. After the fair value gap is formed, it begins to try to draw the price to itself. That's one of the characteristics. And when the price gets into the fair value gap zone, it has another powerful characteristic to push it backward, like a springboard. So when a price comes into the fair value gap and tested the fair value gap, we are expecting the price to bounce off. That bounce off is what we take advantage of. We will take it as a trade. Since the fair value gap is in a bearish direction, we mark the line, the price come back into fair value gap. What do? We remember that it will bounce it off. So we take a sell trade from that fair value gap outwards. So when we take a sell, remember sell is downward, buy is upwards, right? So we take a sell trade from there, from the fair value gap downward, we take profits. We take profits at what we call breakup structure, or some people, we call it liquidity zones. Some people, we call it kill zones. There are so many names for it. We'll talk about that later in the future. But most important, what I want to say is that here I'm showing you that when fair value gap is formed, the fair value gap acts like magnet and it tries to attract the price back to itself almost immediately or later on in the future. Look at this one. Fair value gap was formed here. Candle 1, which is a black candle. Candle 2, which is a green candle. Candle 3, which is a green candle. Where is the fair value gap? Here and here. Fair value gap has been formed with these 3 candles. After the fair value gap has been formed going upward, the next thing we saw immediately was that the next candle that followed it, it's pierced into the fair value gap. So I don't want to use the word pierce. The right word is called encroachment, consequent encroachment after the fair value gap. What is the consequences of the price? The price encroaches into the fair value gap. That is the answer. So if it encroaches into the fair value gap, there is a level we expect. That level is called 50%, half of the gap. Halfway the gap is the level we expect. It's called the consequent encroachment level or mean threshold. So a bullish fair value gap, we usually use the word BC. A bearish fair value gap, we usually use the word CB. BC and CB, the name is just grammar by ICT. It is not important. Forget about the name. Don't even try to remember it. It's not important. What is important here on this page is for you to know that the fair value gap, after it has been formed, it tried to attract the price inside. Or when they try, and also not all, and when the price enter inside, it tried to push the price outward. Once fair value gap formed, it will attract the price inside. Next thing, it will push the price outward. That's how fair value gap behave. When fair value gap is formed, the next thing, it will try to attract the price inside. The next thing, after attracting inside, to push it outward. So it may attract it inside immediately, like this one. It may take some time to attract it later on in the future, but it will attract it, and it has a tendency of repelling it outward. So the process of repelling it outward, that is where we place our trade. I have said a very important thing that summarizes everything we are learning in the next page to the other page to the other page. This is actually the end of this strategy. But every other thing you hear me saying now is just to balance all what I've said so far. But if you understand this strategy, we have come to the end of this strategy. That's the end of it. There's nothing more about this strategy. The rest is expanding it, explaining it, bringing out worst case scenarios, bringing out special cases, and also making you to understand more. Let me read this grammar for reading's sake. Consequent encroachment is when the fair value gap is filled by 50%. So that 50% is very important. When the gap is formed, you target 50% of it. When the price comes to 50% of it, that consequent encroachment is a very, very important area. This is what is referred to as mean threshold of FVG. Traders should keep in mind that price might not completely fill the fair value gap. Therefore, targeting this mean threshold is ideal, not to miss the trade. For me, I like to use the mean threshold, that is the 50% of fair value gap, as my entry point to move to the same direction of the fair value gap. Because sometimes the price does not go down. Normally, let me explain something here. Fair value gap is formed by rapid price movements. You own a supermarket. This is your supermarket, SM. And you sell so many things in your supermarket. Engineer Jimmy, Barrister Jimmy, you sell so many things in your supermarket. Customer come one by one, they buy. You write down what they bought on your book. You balance your book, they go. Another customer comes, they buy from you, they pay. You write down what they bought, you balance your book, they go. Barrister Jimmy, there is a time in your market called rush hour. So many customers will be coming into your shop at the same time. We call it volume. High volume increase into your market at the same time. That high volume entering your market, you as the shopkeeper, you cannot be writing down what they bought on the sheet of paper or on your book to balance your book. So what do? You collect the money, serve him, you go. 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 At the end of finish selling for all of them, you will now come back to your table and sit down with all the receipts. Sometimes you don't even have receipts. You have to think of it in your head. I can remember then I used to sell for my mother. I'll start thinking in my head, oh, who came first? What did he buy? How much did he buy? I'll now write it down. What am I doing? I'm balancing the book. So that is the same thing happening in this market that is causing this gap to happen. This gap is caused by when the price is running with speed. The price is coming with speed. Bullish, 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 bullish. So there is no time to balance the book. So after the book have rested, the shopkeeper must drop the whole situation backward to balance that gap that was created. It's called balancing of the book. So the market must do two things. As a forex trader, there are two things we are noticing in the market. As a professional forex trader, let me correct that. There are two things that happen in the forex market. It is not your support and resistance. It is not your candlestick. It's not your Gartley. It's not your Fibonacci. It's not your Elliott wave. It's not your patterns, your crab pattern, butterfly pattern, your fundamental analysis, your forex factory news. It is not all those things, as good as they are. Everything happening in the forex market can be broken down into two. Number one, imbalance. The market is always going to fill up an imbalance. Number two, liquidity. The market is always moving to go and take liquidity. There are two things the market is trying to do. Either the market is trying to go to take a liquidity, or the market is going to feel an imbalance. If you can look at the market in these two eyes, your left eye and your right eye, one eye is imbalance, second eye is liquidity. You have conquered this market. These are the two things the market will do. It makes you look at the market in a simple form: imbalance, liquidity, imbalance, liquidity. I'll prove it to you as we go on in the remaining part of this lesson. Don't forget this page. If you forget anything I've said on this page, I've talked about two things the market will always do: to go back to fill up an imbalance, or to go and take a liquidity. A liquidity is where money is gathered. Market is going there to clear it. Some people say manipulation. Some people say mitigating. Manipulation. Some people say mitigation. Some people say there's one word again. They said market maker, something like that. They give it a lot of name, but it's just simply the market is going to take liquidity, or the market is going to fill up an imbalance. Simple. This is what I say. Don't forget this statement. Don't forget the two things the market is always going to do. This is the institutional language. The market is going to take liquidity, or the market is going to fill an imbalance. So when you look at the chart, the first thing you are looking for, where is the area of liquidity? The next thing you are looking for is where is the area of imbalance. If you can locate it, that's all. Every other thing will follow suit. Don't forget that the fair value gap, when it's created, it attracts the market, and when the price comes into a fair value, it repels it. And don't forget the 50% encroachment level is very important. I want to repeat what I've said in a more simpler language, that in the fair value gap, when the fair value gap is formed, 1, 2, 3 candle, the next expectation is that we want to see the price go back into the fair value gap. That is my point. And if we find the price go into the fair value gap, we expect that the price go in by 50% of that gap. See price fill up 50% of FVG. That is a good expectation. If we see that happen, it's our expectation. Here we will short this trade because the fair value gap was going down. We'll short, we'll sell. For example, again, if we have a bearish fair value gap happening like this, then we'll see the price going into 50%. This time around, the body of the candle is closing at 50%. It's a good expectation. A good expectation. In the first example, yes, after the fair value gap, the price went back to the fair value gap, but it's only the shadow, the wick of the candle that went to 50%. It's a good expectation. I will trade it. I will regard it as consequent encroachment and trade it. If the body go in by 50% of that fair value gap that you have marked, it's also a good sign. It's respecting the fair value gap. We say the fair value gap has been respected. But in a situation whereby after the fair value gap is formed nicely, the next thing we see the price going to violate the fair value gap. See, it's closing above the fair value gap withdraw. This is a violation, disrespecting the fair value gap. In fact, invalidating the fair value gap here. See price close above FVG. Invalidation. It means the fair value gap is useless. It has rendered its effects null and void. It's not effective anymore because that candle closing above the consequent encroachment, closing above the fair value gap, it makes that fair value gap powerless. So you either get out of the market or forget about using that fair value gap. Yes, if what I've said have made sense to you, somebody give a name, say stop hunt. Good. From the picture, from the second picture, there is FVG behind the one you're showing us. Is it a FVG or not? So just follow me carefully. I think you will understand if we keep going. I think you will understand if we keep going. I don't want to go back to previous charts. So here on this course, ladies and gentlemen, in case you are watching on YouTube, my name is James Ochima, and I want you to sign up for our exclusive 5 days crash course. In this 5 days crash course, I am taking you on a free journey in our physical office at Lekki Phase 1. We had a class today from 11 a.m. all the way to 2 p.m. We have this class. It's free. My phone number is right here on your screen. Chat me on WhatsApp. Tell me the person that invited you. Tell me about the person that gave you this video to watch. You come to the office for free. I'm going to take you through this 5 days course. If you are joining us tomorrow, you are welcome. If you are not joining us tomorrow, you are still welcome anytime you come. We'll organize for this class to be handled for you live in person. And it's free. Basics of the fair value gap is what we are discussing. ICT concepts, the ICT exceptional strategy for fair value gap is what I will show you before we end this call. The fair value gap versus breakaway gaps is what you will see very soon. The liquidity in fair value trading strategy, you will see it. How to choose which fair value gap to enter or to avoid. I will show you this very quickly now because I have shown you the basics of fair value gap. All I will require from you, because I will need something for you, is your commitment and you to be part of our team. We are building a massive team in Africa. We want to save 1 million people from poverty, and we want to use Forex trading. And we have this fantastic strategy that will help traders with trading capital, generate a lot of rebates and commission, and will also make good profit to help the society and make Africa a better place, where we can even use Lamborghini as a taxi in Africa. So this is my goal, and I'm looking for 50,000 people in Africa. So I want you to learn this skill that we are showing, and we are using it. Is working for us, and we want to give you resources, our partnership. We want to give you access to our partners, and we want to work together with you. And in exchange, we are giving you our tools, our resources for free, so we can work together with you in the next 9 months or 10 months or 11 months of this year 2024. Depending on whichever time you are watching this video. Now, all that I've said in the first 3 slides, picture, will be useless if we don't find it in the market. If we don't look at the market to see what is the application of this thing and how can we identify this thing from a real market. This is a chart of a real market, NASDAQ in September 2022. I took a screenshot of that NASDAQ. And it wasn't my screenshot, it's some professional traders who were studying under ICT, Michael Huddleston, ICT SMC strategy, and they were using the fair value gap. So in one of their classes, it was a live classes, I took a screenshot of that screen. I want to use it as an example here. Their name is called Ghost Trader. And in 2022, I was in their master class and they were teaching, and they said specifically to all the pro traders who joined that class, they said, fair value gap can present a new trading opportunity, especially when coupled with order block. When they say that, I wrote it down, and I want you to write it down right now. If you have a writing material, this is a time where I want you to write down. What I want you to write down is what you have on your screen. That fair value gap, if you mix it together with order block, that is going to present a new trading opportunity for you as a trader. So the next question is for people who are hearing the name order block the first time. They want to start asking me, James, what is order block? You don't come again. We have not finished getting this fair value gap. You are bringing order block. And I know order block is something not new, but it is a very, very wide concept and a very, very tough one to understand too. But in the next 2 or 3 minutes, I will simplify order block and tell you what it means. And we will not use it to trade here, but we will always refer to it to increase the confidence of the fair value gap we are referring to. For the purpose of definition, the order block, forget about this thing here. I don't like what I wrote here. The order block is the last negative candle that is formed before you see a lot of volume candles moving either upward or downward. This is a candle going downward. Sell candle, sell candle. Why we call volume candle? Because you see, they are heavy, heavy candles. They are fat. I mean, they are big candles, candles with big body, small tail, big body, small tail, about 3 of them or 4 of them, or even 2 of them. So whenever we see this kind of candle arranging in the market, back to back, arranging in the market, whenever we see that happening, we say that there is an introduction of volume. That is, more volume has been added to this market in the said direction. We just know it. There is a presence of a whale in this market. That's why this price is moving red, red, red in the downward direction. So when you see this red, 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 before this red, red started, you want to see what is the candle, the last candle that was a green candle before the red started. That candle is called an order block. This candle here, you can mark this candle, mark this candle. This green candle is a negative candle in the midst of all of this bearish candle. It's the opposite candle. So this opposite candle before all of this water down, sell, 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 candle 1, candle 2, candle 3, whatever time frame doesn't matter. This negative candle is called order block. So we usually say OB. So you see us writing some inscription on top of the chart. OB means order block. FVG means fair value gap. So what these people are saying here is that when we identify an order block, and after identifying an order block, we still identify a fair value gap. Fair value gap here is 3 candle pattern, this mark, and this mark from FVG. So at the same markets area, we see OB there. Then next to OB, we see FVG there. So these guys, they are saying that this kind of FVG is a powerful FVG that is combined together with order block. I don't want to overflog this issue so you don't get confused. If you don't understand it to this point, it is because you are hearing it for the first time. So manage this explanation until I finish, you understand it. Look at what I'm saying here. There are so many candles here, but I want to pick 3. This one is green. This one is green. This one is green. So 3 consecutive green, green, green. We say bullish, right? They are going upwards. Bullish candle. So whenever we see the presence of green, 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 especially long, long body candles, we just know that there is a presence of a lot of buyers at the same time. Buyers after buyers after buyers. So when we see this kind of push, we call it volume in the market. Volume in the markets have been injected. The last negative candle, which is not a green candle, which is the opposite candle here. This last negative candle is called an order block. So we usually draw that line and check the price. Price is here, remember? Price is here, time is a price time chart. Don't forget that. Those of you that did not do your charts in primary school, your graph book, you throw away your graph book, use it, sell Akara. This forex trading chart is a time versus price chart. So anytime we mark any level, we are marking it in respect to the price at the same time at that particular time or date. This one is happening in 2022. That's where we are marking it. And that is the price of NASDAQ. This is the assets, NASDAQ. This thing is elementary. And we are using a weekly chart. I say I will not talk about these basics. So I'm just talking about it now. But this is not my concept. My concept, my area of interest here in this discussion is this 3 candle, green, green, green going up. Then this opposite one that is red, that is standing before the green started. That opposite one is called order block, which we mark here, weekly order block, because it's on a weekly time frame. So WOB, no, not WOB, so that weekly order block, please. Don't give us so many acronyms. And also, remember the other time I was talking about the mean threshold. That means halfway of the fair value gap. Also in order block, we usually use the mean threshold. Halfway of the order block is where we use. It's very important, right? Don't forget, halfway, 50% of the order block, or halfway, 50% of the fair value gap is where we always use when we are looking for entry or where we are looking to use that fair value gap or we want to use the order block. In this trading, we are not using the order block. We are just referring to it because after the order block is formed, our next interest is, do we have a fair value gap formed after order block formed? The answer is yes. Let's look carefully. Candle 1, candle 2, candle 3. This one starts here. This one starts here. So this place versus this place is an order block. So if this is the third candle, candle 1, candle 1, candle 2, candle 3. There's an order block here, this one. There's a small order block here. Oh my God. I hope these people are watching this thing I'm saying. Candle 1, candle 2, candle 3. There's a not order, sorry. There's a fair value gap here. It's tiny one here. But we are not referring to this fair value gap. Let us look for we can use it. Oh, I'm not saying it's not useful. All these ones I'm showing you, they are going to be useful. But some people will not look further. After the order block, they will use 1, 2, 3. 1, 2, 3 is another, it gives you a more significant fair value gap. This one is tiny compared to this one. If this is candle 1 ended here. This is candle 2, we did not count it. This is candle 3, it started here. So you see this order block, fair value gap. So there is fair value gap here, there's fair value gap here. And remember, we are using halfway the fair value gap. So if you want us to use this one, we use halfway this one, which is the same as this other block, which is why I'm not paying attention to this fair value gap. Because it's the same as the area of the other block we have already drawn. Then look at this other fair value gap after the other block. So now it's going to be other block plus fair value gap. So this other block has been formed. This fair value gap is right on top of it. Half of this fair value gap is where our interest is. Remember, consequent encroachment 50%. So we usually mark that line of half of the fair value gap. So after we mark the line, the candle now formed. The price starts going for so many weeks. Takes a lot of weeks here. So many weeks. So many things happens. We don't want to refer to whatever happens all this week. All what we know is that when a fair value gap is formed, later on in the future, the price must visit that fair value gap. Why? Because that fair value gap is going to act as a magnet that will attract the price into it. Look at what is happening here. It's attracting the price into it. And when the price comes into it and get to 50%, it has the capacity of repelling the price outwards. And that repel outward is what we want to focus on trading. Here, the fair value gap went out, the price danced around, came back into 50% consequent encroachment. At 50% level, we place our buy entry. We enjoy that trade. For 1 week, we're in profit. For the following week, we're in profit buying that market. For 2 weeks, we're in profit taking a buy, taking a buy, taking a buy, taking a buy. On that NASDAQ, we're in profit throughout the 2 weeks because of this fair value gap being visited at 50%. Even up till the next candle that followed it, the price still respect the fair value gap. It didn't disrespect. This is 50%. It closed below 50% is allowed. It goes down to lower, it's still allowed. The end of the fair value gap is here, this place here. If the price closed below the fair value gap, if any of the candle closed below the fair value gap, it means this fair value gap is no longer valid. It has been invalidated. Please no longer use it as a reference point to take your trade. No longer use it as a point to begin to decide a trade. Once it has been violated, you just assume there's no fair value gap there anymore. You look for another fair value gap you want to refer to. There are other fair value gaps up here. I don't want to refer to any one of them because I just want you to see how an order block and a fair value gap is combined to place a trade. That is just what I wanted to see on this chart. I don't want to bug you so much. And I don't want to ask you whether you understand because I want to make sure I say the next thing before I ask you if you understand. Follow me carefully. While I'm saying this, I'm seeing people saying same concept I use order block plus FVG Halima. Thank you, Halima. So what Halima just said is just to add to the fact that when you use fair value gap and you have an FVG, when you have an order block and you have a fair value gap at the same area, moving in the same direction, that fair value gap is a stronger type of fair value gap you can pay attention to. That you know that when price visits that fair value gap, is a very, very strong area of high probability trading decision. Yes, yes. I love that. So we are gradually wrapping up this call. We have very few minutes left before we wrap up the call completely. I want to not differentiate, but just to help you understand that some of the fair value gap are regular fair value gap, normal ones. Why some of the fair value gap are very stubborn Michael Scofield fair value gap. We call them breakaway gaps. Yes, prison break. They are called breakaway gaps. I use this red box to show you how the breakaway gaps behave. There are 2 breakaway gaps I identify here and 2 I know that at some point you missed out what I was showing you, but I'm going to go back again to that page. I was talking about breakaway gaps versus fair value gap. Breakaway gaps versus regular gap, I beg your pardon. That's what I was talking about. And I'm sharing my screen, and I'm sure you can see my screen. And in talking about the breakaway gaps, I have drawn this simple chart. My screen is still coming up. Yeah. To show you what a regular fair value gap means and what a breakaway gap means. Already you know that a fair value gap is a 3 candlestick pattern. So let's take, for instance, this is candle 1. This is candle 2. This is candle 3. Forget about every other candle right now. When candle 1 started from here, it ended here, we mark it. Candle 2, we don't even consider it. Candle 3, we consider it because where it started here. So this distance or gap between where candle 1 started and where candle 2 started is called fair value gap, FVG. Now, breakaway gap is a type of fair value gap whereby candle 3 goes up and closes above candle 2 here. So this type of fair value gap, this 3 candle fair value gap, we call it breakaway gap. This is the fair value gap. It's called a breakaway gap. Good. I'm going to show you again so you understand. This is now my candle 1. I can choose which candle is my candle 1. You can choose any candle. You can refer to any candle as your candle 1. I was telling them this morning, I say, if we are 5 sitting in a round table and there is an elephant in our middle, I am seeing the elephant from the side of one ear. You are seeing the elephant from the side of one leg. The other person seeing the elephant from the side of the other parts. If all of us have a white sheet of paper and we are drawing this elephant, all of us will have different drawings. But all of us, we are correct. Because the elephant is so big. If you sit on the ear side, you will end up drawing a big canopy, and you are correct. If you sit on the side of the leg to draw the elephant, you end up drawing a big tree, and you are correct. So it depends on the angle you are looking at the elephant, that is what you draw. The same thing with these charts. 3 traders cannot see the same thing on the market charts. Every trader can look at the market from his own eyes and perception, what he can see. If what you can see is clear to you, follow what you can see, you are correct. If what the other man is seeing is opposite to what you are seeing, but it is clear to him, what he is seeing is correct. If he follows it, he will win. Somebody can see a buy in the market. Somebody can see a sell in the market, the same market, the same time. The person that can take a buy makes profit. The person that take a sell makes profit. The both of them are correct, depending on your perspective of the market at that time, where you are looking at the market at, your angle of elevation or inclination. So this is, I'm saying this to let you know that there is no law. Say this one must be candle one, that one must be candle two. Anyone you choose as your candle one is candle one. So in a case where I choose candle one, candle two, candle three, I want to show you breakaway gap versus regular fair value gap. Candle one started from here, candle one ended here. We mark it. Candle two, no problem where it started, it doesn't matter. Candle three started here, we mark it. The gap between candle one and candle two, candle one and candle three is called FVG. That's the gap between candle one and candle three. I'm sure by now Barrister Jimmy understand. Barrister Jimmy, if you understand, write yes on the chat box, because I've mentioned this thing many times. So we have seen that this is a fair value gap, but which type of fair value gap? Now, it depends on candle 3 and candle 2 for us to know the type of fair value gap, whether a regular fair value gap or a breakaway fair value gap. It is a breakaway gap if the third candle grows up above the close of the second candle. It is called a breakaway gap. That is why I color it red, so that you can see the red guys. This breakaway gap, they are very, very powerful fair value gaps. When breakaway gaps are formed, the market will just keep going. It doesn't like to come back very soon. It will take a long time before the market comes back into that fair value gap again. That's how breakaway gap behave. They don't come back instantly. Unlike their brothers, the other type of fair value gap, which we call the regular gap. I'll show you here. This be my candle one. I'm really struggling here with time. I'm really struggling with time. You see the thing going off and on is because of the timing. Please, if you can hear me, put yes on the chat box. If you can. You can hear me, but the network is not allowing me to proceed. And I really do not want to break this class. I want to flow with this class to the end. I just have barely, I'm in item 7, right? I have 8, 9, 10, 11, 12. Only 4 slides left. So please, I want to finish this 4 slides. It's not good to leave. I want this. It's not good to give a half knowledge. It's very destructive. It's good to give the knowledge completely the way it's supposed to go. Permit me to just try and struggle it and finish it. Very, very important. So everybody can hear me. I'm going to begin to round up. I will try my best to speed up to round up very. All right. So, regular fair value gap. And I said candle 2, candle 3. I'm actually writing on my screen, but the delay is massive. Okay, I will go slowly because of these delays. First candle ended here, we mark it. That's how to mark fair value gap, Abi. Second candle, we don't need to mark. Third candle started here, we mark it. Barrister Jimmy, the gap between the first candle and the third candle is called FVG. Somebody asked me yesterday, say, James, why do you like mentioning our names when you are teaching in the call? Actually, I learned that thing from Pastor Chris Delvan. I used to attend Chris Delvan's church in Kaduna so much. He will never ever finish a message without mentioning the names of almost everybody inside the service. If he knows your name in that service, he will use that church, we know your name, and we know you because he uses you for the example. And guess what? That thing really helped us because every time we try to remember what he was teaching us in all of those sermons, because of all those names he was mentioning, it was easy for us to remember those things. And that people in the class, because he's the one that said, so he's the one that said he didn't understand fair value gap after we have more than 20 people who said they understood. So he became the lab rats for experiment. So I'm sharing my screen. I'm sharing my screen and I'm trying to round up. Please just bear with me. The network is crazy and crappy, but then we don't want to cut down the recording and stop the class because it will not be good for us to have a part 1 and part 2. It will at all, it's not be good at all. First candle, second candle, third candle. The best thing to do is to speed up the class. Mark the fair value G. Done. Most times we can even use our eyes to mark this thing without putting lines on the chart. Then you check candle 3. Where did candle 3 close? A candle has 4 characteristics: candle low, candle high, candle open, candle close. There are 4 characteristics of every candle, whether bullish candle or bearish candle. If I draw a candle right now, whether bullish candle or bearish candle, there are 4 characteristics of this candle. Number 1 is candle low. Number 2 is candle high. Number 3 is candle open. Number 4 is candle close. So anytime you hear me say close of candle, I'm talking about the body. Anytime you hear me say open of candle, I'm talking about the body. Anytime you hear me say candle high, I'm talking about the tip. Anytime you hear me say candle low, I'm talking about the tip. Don't confuse them for each other. So here I'm talking about candle 1, candle 2, candle 3. I want to describe these guys. And I say, after identifying the fair value gap between candle 1 and candle 3, you need to look for where candle 3 close, not tip. Candle 3 close below the candle 3 close below the high of candle 2. This is a signal of regular fair value gap. Unlike the breakaway gap, candle 3 will always go up and close above the tip of candle 2. That is a signal for breakaway gap. But in regular, it will not happen like that. Why? are we interested in whether candle 3 do not go up or whether it go up? It's because any fair value gap that is a regular fair value gap, it will attract the price into the fair value gap faster. The next candle immediately will come down into the fair value gap. That's what we have seen. Go and check all the market. I want you to go and backtest all the candle chart and see. When you notice a fair value gap, especially this one with regular FVG, after the 3 candles have been formed, the regular FVG, the next candle will like to come inside the fair value gap. Unlike the other type breakaway, after the 3 candle is formed, the next candle will not come inside. It will not like to come inside the FVG instantly. It will go for a long time before it now later come back inside the fair value gap. So the difference between the regular fair value gap and the breakaway fair value gap is that the regular fair value gap instantly, almost immediately, after the 3 candles are formed, the next candle will come into the fair value gap that we have drawn. Immediately, the next candle will start coming into it. Why for the other one, the breakaway gap? After the fair value gap have been formed, the candles will be going up, dancing up above. They will not come into the gap until after a while before they come into the gap. You will understand this in the next chart. All what I'm saying is not hard, it's not difficult. It's broken down bit by bit as we check the next page, we check the next page, we check the next page. This is a sell setup. But in this setup, I will not talk about what I spoke before. I want to add one more information, then I close the whole class with summary. I want to add one more information here. That information is called liquidity sweep. So if you like, you say buy side liquidity or sell side liquidity. I want to talk about it here. Buy side liquidity sweep or sell side liquidity sweep is an important factor to choose which fair value gap we will trade or which fair value gap we will not trade. If we see other block, it is part of a reason for us to choose a fair value gap and trade it. If we see a liquidity sweep, it is part of a reason for us to choose a fair value gap and trade it. What is liquidity sweep? When the price is moving up, moving down, moving up, moving down, moving up, moving down. All of this place, there are areas of liquidity. Intermediate trader just bear with me. We are almost rounding up, and you know that end part is usually the most interesting part. I'm talking about the movement of the market. The price movement with these candles, price will go up, price will come down, price will go up, price will come down, price will go up, price will come down. The price moves like that in these markets. So, and when the price is moving up and down, all these areas, the tips, all these areas of this market, beginner traders, intermediate traders, newbies, they call these areas swing high. They call these areas swing low. They are correct, though, but they are beginner traders. I'll tell you what the professionals call them. What the banks call these areas is not what you call the areas. You who read the books, who learn the regular trading, you call these areas swing high, swing low, swing high, swing low. Some people say this is higher high, lower high, higher high, lower high, like that. It's correct because that's what the textbook says. But the markets, the market makers, otherwise called the banks or the liquidity, the main big pocket people, the big boys of this market, coming with thousands of dollars, millions of dollars to this market. They call these areas of liquidity. They call these areas of liquidity. So when they see a tip like this, they mark it up. They see a tip like this, they mark it up. They draw these lines. Now, where they see that so many lines are gathered, that means liquidity, liquidity, liquidity. They draw all these lines that you call swing highs, and they consider these lines as liquidity zones. So they call it liquidity. You call it swing highs, but they call it liquidity. Where they see liquidity gathering, they want to go and sweep the liquidity. And when they sweep the liquidity, they will drag the market down and sweep on that liquidity. That's how they behave. When there is no more liquidity, they will allow the traders to start trading up, down, 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 up, down. As the traders are trading, forming up, down, up, down, the marketers are marking areas of liquidity. When they see that liquidity gather in an area, liquidity, 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 the next thing you will see, they will go up and sweep that liquidity. And if there's another liquidity gather downward, they will come down very sharply and sweep that liquidity, and they will allow the traders to continue. Know if maybe the recording is more clearer than the live Zoom call. I pray it's so that when you watch the recording, you can see in totality what I was saying. But if anybody got my last sentence, I really need to know, because I'm feeling like as if some people are left behind. If you got my last sentence, please type it on the chat box. I want to know my last sentence, the one you got, so I will know what to say next. I'm trying to manage our time now. Please, if you got my last sentence, what was the last thing you heard me say? I have only 3 slides left to the end of this call, and we have to finish it. 1, 2, 3. What was the last thing I said before we went off? Liquidity sweep. Thank you. Thank you. So the big money banks, they are always going to look for liquidity and sweep it. Look at the charts. You, Mr. Cletus, you saw that there's a swing high here, and you put your stop loss there, because that's what trader put their stop loss. You saw there's a swing high here. You take a sell, double top sell here. You put your stop loss here. This place you put your stop loss. The market makers, they have marked that line. And when they mark that line, in their mind, they say that is liquidity. They call it liquidity zone. So there are 2 lines there. There's another high here. Somebody puts his stop loss above that line. The market makers mark that line. When they even come here, so when they were coming upwards here, this is retail traders trading all this. Some people place a sell here. They put stop loss here. Some put stop loss here. So what happened here? This area here gathered a lot of liquidity. Stop loss is called liquidity. Or buy stop or sell stop. They are called liquidity. This is liquidity here. So what the market makers will do, the big banks, when they come here, they will draw a little bit. They will come with a lot of pressure. Buy, 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 boom. So all the stop loss here will be hit, taken out, taken out, taken out, taken out, taken out. The market will go up. So this process of taking out all this liquidity is called liquidity sweep. With the liquidity they take, they took this liquidity out, they took this one out, they took this one out. A lot of money is resting there. That is why I say the market is looking for liquidity to sweep. Number 2, the market is looking for I repeat, the market is looking for constantly liquidity to sweep. The market is looking for imbalance to fill. The market is looking for liquidity to sweep. The market is looking for imbalance to fill. What is the market? The big money. I have just changed my network. I've just changed my network. I hope this one will help me finish this call. Let me conserve my words so that we can wrap it up. I really want to wrap it up and have an ending. There is a liquidity here. There is a liquidity here. The market sweep the liquidity. Then the market starts coming downward. When the market starts coming downward, that's the character of a liquidity sweep. After the sweep of a liquidity, the market will come down very, very fast. When the market starts coming downwards, find fair value gap there and trade that fair value gap. That is my main point. If you read what I wrote here, you understand that when the buy side liquidity has been collected, we anticipate a reversal. Wait for shift in market structure and confirm that reversal. Once shift in market structure, look for fair value gap and use it as an entry point to short sell. So you can trade a fair value gap when you locate a market sweep have been done. The market is trying to do that next move after market shifts. Find a fair value gap there. Take advantage of it. So invariably, I'm saying another fair value gap you can trade, and you trade it very, very safe. It's a high probability fair value gap. It's a fair value gap that is formed after a market liquidity sweep, either in the buy direction or in the sell direction, the same thing. This other chart here is the opposite of what I've said. There is liquidity formation in the market, which is stop loss here, liquidity here, liquidity here. A lot of liquidity gathered in this market, and the market came down and sweep that liquidity here. This is the sweep of that liquidity. It sweep up all the liquidity, and after the sweep of the liquidity, the price is going, the character of the price is to reverse back quickly to the next area of liquidity, which is around this side, to go and clear it. So imagine that you are seeing a fair value gap after a liquidity sweep. You have a long push, 1:7 risk reward ratio. This is why I have no doubt about our strategy for the prop firm, our strategy for the PAM account, our strategy for the account management in any broker. I have no doubt. Because if you are using fair value gap and you are now adding it with liquidity sweep, with order block, you can get 1:8 risk reward ratio entry. Take profit 1, take profit 2, take profit 8 if you are using this. Are they easy to locate? No, they are not easy to locate. But if you have the Envision You app, some of the trades called by Courtney Logan is a wizard in this market when it comes to price analysis, especially Doss Jones. They call him the US 30 master. He's a very fat guy with small head. He's in America. On his trading floor, he is a master of US 30, S&P 500. He is the one that sends that signal by himself. And he usually uses liquidity sweep to identify the markets. When he's able to identify this market and he sends that signal, and you see that signal, you plug your chart, and you notice that this is a liquidity sweep signal, you will take that signal without looking back, because a lot of money is going to be made in 2024, which is why I don't joke with the signals that come from Courtney Logan, especially the DAX 30 S&P 500 signals on the Envision You app. So those of you that have access to the Envision You app, I want to congratulate you, because what you have is very, very powerful. And those of you that don't have access to the Envision You app, I'm sorry. I'm so sorry. There is nothing I can do to help you. I can't send you signal. You have to go and identify this liquidity sweep by yourself. Check US 30, check S&P 500, check NASDAQ, check GBP USD, check gold, check all the checkables. After you check finish, you don't find it, you check tomorrow again. If you don't find it, check tomorrow again. When you are tired of checking, if you find one, use it. But to cut your stress short, you don't need to be checking. These guys are sending this signal with this same analysis to you every day. You check what they have sent and compare it if it has liquidity sweep, if it has order block, if it has fair value gap. Take that trade with your full chest. Put your money there. A lot of money is going to be brought home before December. The owner of this fair value gap strategy, the guy who identified it and used it and started showing us about the fair value gap. Sorry about the video. I'm sure that the recording might be something very great. We still have a live recording, so let's see if the video will help us. Good. I like the responses from the chats. Catherine, sorry about the video. We'll just try to wrap it up, but I'm sure we have the recording clean. You can rewatch it. The guy, go and check on Instagram, Michael Huddleston. Go and check this guy on Instagram. Everybody. This is the ICT master himself, Michael Huddleston. Go and check him also on YouTube, Michael Huddleston. But I promise you, you will not understand what he's teaching. It's very, very technical and complex. To attend Michael Huddleston's class is $10,000. It's a 1-month class. It's called ICT SMC. He holds that class twice in a year. $10,000 per student. Very, very complex, complicated class. Too many names, too many grammar, so many things. Very, very confusing. The first time I went through the course, I didn't understand anything. So after many years, some people began to crack his course, simplify it, compress it. And right now what I'm doing, I'm breaking it down to simple language where ordinary people can understand. In fact, I divided the whole course into 3. Number 1, timing. Number 2, liquidity. Number 3, risks with entry with risk management. I was successfully able to divide all the complex things into 3 simple things. Timing. What is timing? Make sure you are using fair value gaps in kill zones. What is a kill zone? Of course, that sweep area. Of course, that other block area. I don't want to say Fibonacci kill zones. These 2 kill zones I give you, order block, sweep area, they are very, very good kill zones. That is what he's saying concerning the timing. And he also added that these kill zones should be done when the highest trading setup occur. When is the highest trading setup occurring? That's the correct English. I want to ask a question in this class. Who can tell me the times of the day when we have the highest trading setups? Who can tell me that on the charts? I want to see the charts. I said it yesterday and I gave you those times. Yes, Envision You app is a paid app, $250. $250. Yes, Martin, you are right. 2 p.m. New York open time. Another very good high probability time where highest trading setup are formed is what? 8 a.m. That is the London time, London open time. In Nigeria, this is the time. So please, in Canada, you need to check what is London open time, what is New York open time. Check the time for Canada, check the time for Abidjan, take the time for other countries. It's very important. Yes. Then, when you add these timings, so what he's saying here is that if you find your order block, if you find your fair value gap within this time, that your trading setup will be very, very fast, sweet, and profitable. That is what he's saying. And yesterday, I gave you 5 assets, I mean 6 or 7. I mentioned US 30, I mentioned NASDAQ, I mentioned S&P 500, I mentioned WTI, US oil, I mentioned also GBP USD. I mentioned XAU USD. That's gold. 7 assets. These assets, they are very, very good assets that respect structure as far as this strategy is concerned. So we are paying more attention to these assets, more attention. Me, I love GBP USD, and I also love WTI, oil, US oil. I also love S&P 500. If I don't find setup in oil, I find setup in S&P 500. If I don't find setup in S&P 500, I find setup in GBP USD. On worst case scenario, I go to gold. Yes. So, number 2, he talked about liquidity. He said liquidity can be observed through the chart by sell stop or buy stop kill zones. That's that liquidity sweep I was talking about. So ICT said it. A summary of everything is teaching that it's all about liquidity hunts. Once you see a liquidity hunt, then take advantage. After the liquidity hunt, if you come down to lower time frame, you can make money there. Before the liquidity hunt, you can make a lot of money there in lower time frame. So people who are scalping with smaller time frame, they take advantage of this. Near a hunt of liquidity, they know that it's a high probability entry. They take advantage of it. It always works. Always. It never fails. If you identify it. If you see plenty of liquidity and price going close to liquidity, just know that it's a very good area for you to begin to look for fair value gaps, to hunt that liquidity down, and take your profits after the liquidity is swept. So he talked about the risk management, that we wait for the market to return and fill these imbalances. If you are using fair value gap, you must manage your risks. Make sure that these fair value gaps are filled, either 50% level or 25% level, 25% third quadrant level. I will show you what that means in the next chart. Then employ your proper risk management so that you cannot risk more than 0.5% of your account at any trade. Some people who are good traders, they risk 1% of their account at trade. Some people who are very good traders, they risk 2% of their account on a single trade. But somebody who is trying to manage his account for the long time, we advised them yesterday. If you were here in the first class, what is our advice? Gas oil. Gas oil, I don't know what's gas oil. I'm talking about US oil. Maybe some brokers call it gas oil, but that is WTI. It's called US oil. Maybe it's also called gas oil, maybe, but compare the chart, you'll find out. What is the, no, I'm talking about the minimum risk per trade, not risk reward ratio. Minimum risk, how much? No, yeah, this is in price. Thank you. 0.5%, Catherine, percent. 0.5% of your account. If your account balance is, if your account capital is $30,000, for instance, what is 0.5% of $30,000? This is $150. So we say in every trade you enter, if you see minus $150, close the trade in loss, accept the loss, and look for another trade. That is what we mean by risk management. Yes. So the risk reward ratio, it means that if you are risking 0.5%, that means you are targeting to make a profit of 1.5%. In dollar sign for a $30,000 account, that is $450 in a winning trade, while $150 in a losing trade, if we are talking about $30,000 account in our case study. So if you watch the risk management training, you understand what I'm trying to say here, because I explain it very well there. So as we begin to round up, it's just to show you the live markets of Euro USD, where a trader identifies liquidity sweep. After he identified liquidity sweep, he take advantage of the order block that was formed after a liquidity sweep. Also, this trader also saw order block and also saw fair value gap, and he took a very nice trade. This is a live trade that I screenshotted. This trade was going upward, going upward, going upward, going upward, formed a swing high, which is called liquidity. After forming the swing high, then the trade swept that swing high, broke that swing high. We call it buy stop liquidity. It's called liquidity sweep. So this buy stop liquidity is our signal number one. Number two, we see the market coming down fast after the buy stop liquidity. It's our signal number two. So we see a buy stop liquidity cleared out. We see a market coming down to play that sweep, cleared out. We see an order block formed. Remember what is an order block? Signal number three, order block. Then we see the price going back. Then we now see a fair value. We now draw a fair value gap. Candle 1, candle 2, candle 3. Fair value gap drawn. After the fair value gap is drawn, we now wait for market. Now, which kind of fair value gap is this? This is, of course, you see, the gap, the flow of the market is telling you that this is a breakaway gap. Although there is something here invalidating that breakaway gap, but it's an exception anyway. I don't want to talk about this so much. But the point here is that the price came back into the order block. This order block, the moment the price enter into it, half of the order block, I will load my sell entry. Why am I loading my sell entry? Without any fear or favor. I've seen a break of structure, price going down here, change of character. I've seen a liquidity sweep. I've seen order block, half bar. I've seen so many things. Then I've seen fair value gap as my entry. So, and some traders who are doing structure, they have seen what is called flag pattern. Me, I'm just waiting to see liquidity sweep. I'm waiting to see fair value gap. I'm waiting to see order block. When price goes back into fair value gap, I load my entry here. 0.5. 0.5 risks. 0.3 lot size. $30,000 account. Sell. When I sell, where is my take profit? My take profit is the next liquidity sweep. Where is the next liquidity sweep if I'm going downward? The next liquidity sweep is swing low, this side. Some people say this one. I don't correct with them, but this is the main liquidity sweep. After this one, this is the next liquidity sweep. The most significant swing point is the next target for that fair value gap. Or for that market guys, market makers. So they are going to come down here to sweep this liquidity. So on their way coming down here, if I take my trade here, 50 pips stop loss or whatever above that swing, this is risk 1:1. This is risk 1:2. This is risk 1:3. I will take my profits. So this is everything that I've taught today in one single chart. Everything in one single chart. Everything I've just taught you in one single chart. Lastly, to summarize again, high probability entry is based on half of the fair value gap. If a chart is going upwards, you notice a fair value gap, 1, 2, 3, you mark your first, you mark your third, half of that gap, that is where you are looking for your entry. When the price comes into half of the gap, that is where your entry is. Take your entry, continue going the direction. High probability entry again. When you have a fair value gap going this way, you find your 3 candles. It starts here, it ends here. This is your gap. When the price comes down and comes below, it's more than half of the gap. It comes below. If you divide this gap into 4, this will be half. This will be first quadrant. This will be second quadrant. This will be third quadrant. This will be fourth quadrant. If the fair value gap draw price into fourth quadrant is a good probability trade, take it. It's a good trade. Buy, continue to the upside. Avoid this type of entry. If a fair value gap is formed going upwards and the price is attracted downwards and it closes below the 50%, this is 50%, the price closed below 50%, don't enter the trade. If the price closed below fourth quadrant, don't enter the trade. If the price close below the fair value gap, get out of the trade. That is a bad fair value gap violated. Some people say they will not get out, that the market can still come up. I agree. Market can come up. If you pray hard, it will come back. It will come back. A lot of people have blown their account. Let's wait for it. Let's add one more entry to come back. Don't add another entry once the fair value gap has been violated. In fact, look for how to get out of the market. Don't enter that trade once the fair value gap has been violated. The market is supposed to be going up, but the price closed below 50%. It's a bad fair value gap. It closed below third quadrant. It's a bad fair value gap. It closed below the fair value gap itself entirely. It's a bad fair value gap. Avoid that entry. Don't enter again. If you are in it, get out. If you don't want to get out, you need to go to the higher time frame. If this was H4, go to D1 and go and check for daily bias. I'll be teaching about daily bias tomorrow. So tomorrow, if you are with me at Lekki Phase 1 live, those who attend the live session, they enjoy this training better because they stop me, we start again. They stop me, I look at their laptop. You know the way teachers go around in the classroom. That's what I do. I check their laptop, I check their phone, I check their notes. I do correction for them while they are writing. Right now, I don't know what you are writing. I don't even know what you are hearing. So that is the limitation of online class. For those of you who are with me in the office, Lekki Phase 1, call my number and I will tell you, this is the room number. Come to the meeting room. You will get a first-hand training from me. This training costs $10,000. You will get this training directly from me. Chat me on WhatsApp. Come to the room where I am. I will look at your computer. I will set it up for you. I will look at your jotter, what you are copying. I will set it up for you. And you'll be learning, taking me back, taking me front, taking me back, taking me front. You will learn this thing better. It is free. I am not charging you. I'm not charging you. It's free. And after you finish the class, I will give you the PDF. It's just 12-page PDF. I will give it to you free. Every one of you that have watched this video, chat me right now on WhatsApp, 08135906599. But if you are not in Nigeria, +234. Chat me on WhatsApp and request for the PDF. Tell me, I have read, I have watched the video, I want the PDF. I will give it to you free. Tell me you have watched the video to the end, you want the PDF, I will give it to you free. Yes. And once you get the PDF free, request for the other video, day 1, day 2, day 3, day 4, day 5. If you have all the video together, then you are part of what we are building in 2024. You see, we are not in a hurry in 2024, say bring money, bring money. No, we want people to understand what we are building. At the end of the day, you are not the one to trade this account. We will have traders who will be trading this account using this trading strategy. But if the trader violates the strategy, the trader will pay the money. Yes. And if you see the trader violating the strategy, you will know and you will cut off the trade. Some traders have better strategy than this one. I want to balance what I'm saying. I have met some traders that have better strategy than this, more professional strategies. And these traders have decided how they want to trade. Allow them to choose their trading plan. But if the trader agrees that he wants to use the trading plan we have designed, the trader must not trade outside the plan. What do I mean? It must not use 0.4 lot size. It's a violation of our plan. It must not allow the trade to go more than 50 pips stop loss. It's a violation of our plan. The trader must not allow the trade to go negative more than $150 on your $30,000 account. It's a violation of our plan. However, if the trader is professional, he can redesign the plan and show you the plan. I will use 0.5 lot size. I will use 10.0. I saw a trader that was using 10.0. His stop loss is 10 pips. And he didn't violate the plan. He didn't violate the maximum drawdown, 6% maximum drawdown. He didn't violate it. So it is possible for a trader to come up with a trading plan that will not violate the maximum drawdown of 6% and still win. But we have designed a simple plan that anybody can use if he follows the strategy, and it can win. And the losses will be so small compared to the account size. You can use this design to trade a $50,000 account You can use this design to trade a $500,000 account this year. We'll show you how to trade a $500,000 account, and we will help you get this account either by PAM, either by prop firm, either by an investor bringing the account and giving the account to you. I have met investors recently, even today, some came to my office today. They said, James, we love this plan. We want to test this plan. If this plan is working, we want to put money in the account. Please choose a trader that has followed this plan. Let us have a discussion with the trader. We'll put money in a live broker account, not prop firm. The trader will trade this plan exactly. So if you are trading an account of $500,000 and you follow this plan exactly, if you lose 6% of the account, the owner of the money will not hold you responsible, because that is just 6% of his account. He will take the balance and go away, or he will leave the balance in the account for maybe 6 months, and he will withdraw the total balance in profit, because inflation will move the money up again by 6% and more. But if you are able to do good 12 trade, maybe 4 good trades out of 12 trades, your account will be in a profit of 5% of $500,000. Press your calculator. That is $25,000. So you don't need to be the one to generate this money to be able to trade it. I have access to big billionaires that are coming with a lot of money to this market, but they want to be sure if the money is safe. And if we can show them a plan how the money is safe, they will bring the money. I have the access. And we are currently creating more access. And how do we prove it? By doing it with a demo account. How do we prove it? By doing it with our own prop firms account, our own PAM account, our own live account. Then when we have multiples of record like this, it has proved a track record of proven performance. This is exactly how we'll get the 500K. From the prop firm, from the investors, from the PAM. I mentioned 3 ways. I don't want to mention more ways because I want us to be focused with just few examples. Even you as an individual, when you see a strategy working and the strategy is having more probability of working, you will go and look for money by yourself and trade it by yourself. Everybody wants to make money. This is 2024. So ladies and gentlemen, I want to thank you for your time. If you have questions, I wish I was in Lagos now. Some people flew into Lagos to be in this class. I don't know, somebody saying, I wish I was this, I wish I was this, I wish I was this. It's a 5-day course. Some people flew into Lagos for this session. I don't like giving hypes. Myself, I don't live in Lagos. I flew into Lagos because of this thing. I flew into Lagos because of this thing. I was in Abuja all through the weekend with my family. I flew into Lagos on Sunday because of this. So if you hear you sitting down there telling me I wish you were in Lagos, I'm saying like, who is this guy? Are you serious at all? Thank you so much, Mohammed. So those of you in Lagos, make sure you are in the class tomorrow. We are going to dig deep into the next concept. The next concept is the same thing. We are not doing so much. The same thing. This is all we are doing, fair value gap. But the next class for tomorrow is it's called daily bias. It's called the liquidity. All the other ingredients that are surrounding the fair value gap. I want to break it down tomorrow. Tomorrow's slide is about 7 pages, not long. So I will do it tomorrow morning, and I will also do it in the evening. So those of you watching this video, you have my number already. Go ahead and reach out to me. Get your PDF. Become part of the team. And if you don't have your demo account, get your demo account ready so that when we start calling the trades, you are also entering the trades. You know the trading plan. You will get the signals. You enter the trade. If you find the signal by yourself, you send in the signal. We will look at it, and then we will say, yes, this signal is good. We will take the trade. Your assignment for today, open your charts. Those of you that have a chart, identify fair value gap, mark it, label it fair value gap, post it in the group. If I see you post this assignment, I'll be very, very happy that somebody got what we have taught. Identify liquidity sweep. In any time frame, in any assets, in any chart. Identify it, draw it, mark it, and label it liquidity sweep. Post it in the group. I want to be sure that somebody understood what I taught. Identify order block. Mark the order block. Mark the fair value gap that followed it. Screenshot it. Send it to the group. Label it. I want to see that you can identify order block, fair value gap, liquidity sweep. That's that volume sweep. Identify breakaway gap. Mark it. Screenshot it, either from your phone or from your laptop, anywhere. Post it to the WhatsApp group where we have 5 days course there. I want to be sure that somebody out of the class understood what is called breakaway gap. I'll be very happy. And I'll take note of you. Identify regular fair value gap from the charts. Screenshot it, mark it, post it in the group. I want to see it that somebody understand what I have taught today. These things I mentioned were all the things I have taught. Then request for the PDF, I will give it to you for free. Thank you so much for your time. My time is up. I can see Caroline, she's really enjoying everything here. I can see she's enjoying it. Honestly, I can see you are enjoying it. Thank you, everybody. My time is up. Thank you for your. See you tomorrow.